Welcome to Market Call. Thanks for joining us today. I'm Marella Fernandez. David Burrows with us on the show. He's Chairman, Chief Investment Officer, Barometer Capital Management. He's going to take your questions today on North American large caps. Here's how to reach us. 1-855-326-6266 if you want to dial in. You can also email your questions, marketcall@bnnbloomberg.ca. Thanks for coming in. Good to see you.
Great to see you.
Let's talk about where we are in the season. Kind of the end of summer. We usually think it's quieter. September, typically more volatile. You call this sort of a trickier time of the year. Why is that? And what changes are you suggesting for investors ahead of September?
Okay, well, let's talk about why it's typically tricky. You get to the end of August. Analysts maybe have come into the year a little bit overly optimistic. They get to this time of year, they say, oh boy, I better cut back my estimates. So seasonally, we've seen a lot of weakness at this time of year. But that's like in every year. The truth is, this year, analysts took estimates down pretty sharply in the first and second quarter, and actually have now been revising up later in the year. So that's one thing that's different. Second thing is, market came in on a pretty good footing, into the middle of August. After, I think market's up 1.2 or 1.3% so far in the month. So that makes it different as well. When in years when the market came in on pretty solid footing, third quarter didn't wind up being so bad. Having said that, we generally come into this time of year with 5 or 7% cash. There are things to do. Global markets are behaving really, really well. Canadian markets behaving really well. But we just address the fact that it can be sloppy end of August and September into October.
Do you think then, as you mentioned, because there was so much revision at the start of the year from tariffs, that we might buck the trend of seeing weakness or volatility in September?
If you look at the revisions that have been taking place over the last month, a little over 60% of the revisions have been higher. So revisions are going higher in the fourth quarter, and they're going higher in the first quarter of next year. So that's positive. Now again, there are sectors where we're seeing it, like financials are seeing great revisions. Industrials are seeing pretty good revisions. Technology is seeing good revisions. Communications, good revisions. Healthcare going the other way. So again, it's sector by sector. There's a market of stocks. It's a market of sectors. And there definitely are haves and have-nots in the market we're in right now.
Okay, so cash aside for September?
Yeah, we've got 5 or 7%. We've continued to add positions in global markets outside of North America. We think they look really, really constructive. And we have more Canada than we would typically have. The Canadian market solidly outperforming the U.S. and market internals, or breadth, the percent of stocks performing well, is better in Canada than it is in the U.S.
Okay, let's leave it there for now. We'll line up some phone calls and some emails. We're back with David Burrows of Barometer Capital Management in just a moment. Here's how to reach us. Stay tuned. Welcome back. David Burrows with us to take your questions. We'll start with an email from Ashley. She says, what are your thoughts on KKR on the New York Stock Exchange? So an investment company, do you know it?
Yeah, sure, absolutely. So KKR is the big private equity company that's been sort of the granddaddy over time. We think that we're in a market where liquidity is of value. And in the private equity market, there have been difficulties getting different cohorts of private equity deals liquidated. So we are less interested in that. Because long-term interest rates have gone up over the last 4 years, the discounted future value of cash flows is more difficult, and we think that there are a fair number of deals out there that are just priced too high. And so as a result, until we see the market for liquidating these private equity deals really open up, we would probably focus in other areas.
Got it. Okay, let's go back to the phone lines then. Lorne on the line. He's calling from Ontario. Hi, Lorne.
Yeah, good afternoon. Before I ask David a question about a stock, I have a suggestion for the top picks format of the show, which invariably focuses on 3 stocks a guest recommends to buy, supported by the reasons they recommend them. As investors, we tend to identify more easily with what's going up than what's going down. When the thesis for purchasing a stock changes and it reaches an inflection point and changes direction and starts declining. So my suggestion is that it would be useful to either add a fourth top pick at the end of the show that a guest recommends selling, or have a guest recommend 2 stocks to buy and 1 stock to sell to give investors an opportunity.
Thank you for the suggestion. We do have to get to your phone call about whatever stock you want some information on. So if we can forward to that, that'd be great. Okay, I'm not sure if we lost him there. That was Lauren. He had a question about Alamos Gold. So if we can just talk about gold, a lot of gold in the price, which has been moving up in the first half of the year, kind of settled in around 3,400, I think. Yep. What is your take on Alamos Gold?
Yeah, so Alamos Gold is an interesting mid-cap stock. It's one that I own personally. We own in some accounts. Alamos is a multi-mine producer, and it is in friendly jurisdictions. A lot of their production's in Canada. I think the reason the stock pulled back a little bit from April, first of all, gold has consolidated, but some of the earlier production from their mine in Manitoba has been lower grade. That should pick up. So I would be a buyer of the stock here. I think it's consolidated with the golds. Gold producers have started to outperform the metal itself. That tells you that we are in a bull market. That was not the case until a couple of months ago. And so given that we've had a time consolidation and the price of gold is solid, I would be interested in adding to positions here, and Alamos is one that I think we're going to see a pickup in results over the next 3 quarters.
Okay, thank you for that. Let's go back to the phone lines. We have on the line right now Brian from Ottawa with a question. Hi, Brian.
Good afternoon. While I'm well aware that in recent weeks there's been price weakness in the natural gas commodity price, the share price of Tourmaline oil has, in my opinion, disproportionately dropped from over $67 to trading in the 56s this morning, while comparables like ARC have not dropped as much. ARC is in the middle of its 52-week range. Tourmaline is threatening the 52-week low. Are you aware of any information to have any concern about Tourmaline itself, or do you see this as a buying opportunity? Mind you, while we're heading into seasonal weakness, if you see it as a buying opportunity, would you step in now, or would you wait for possibly it dropping further or even breaking below the 52-week low?
Yeah.
Thanks.
Okay. Brian, thank you for the
Brian,
question. Go ahead.
It's a great question. Now, look, everybody has a different process for making their decisions. You know, in our process, we like to recognize that we don't know everything. And so one of our basic tenets is that if a stock isn't behaving the way you think it should, given what you think you know, assume you might be missing something. Second thing is, no matter what you buy, you think it's a good idea, at some point you have to sell everything and you have to have some discipline around it. So our premise is we want to own the leading company fundamentally and the leading companies technically. You know, price is doing what we would hope or expect them to do if they are changing for the better. So in the case of Tourmaline, look, we are in a seasonally weak period for gas. Give you a sense, we were probably 12% energy in this early spring. We're 6% right now. We're focused on long life assets. So Imperial Oil would be a great one, but they're like the 3rd lowest cost producer of oil, you know, in the majors. Mm-hmm. So they can survive very low prices. So in the case of Tourmaline, you know, first of all, relative to the rest of the market, it's only trading better than 19% of companies in the S&P. So it's been relatively very weak. It's making relative strength new lows. The energy sector has been sloppy. Breadth in the sector has been weak. When that will turn around, it will turn around at some point, but from what level, I don't know. So we wouldn't be adding anything in energy right now. We would be erring on the side of caution. But we're not value investors that are trying to buy low-priced, out-of-favor stocks, and there's other people that would probably give you a different answer.
And there's nothing about Tourmaline specifically that you can see that's dragging it down a little bit more than others in the space?
Not that I can point to. But, the nat gas space is tricky right now, and I think that maybe I would wait and see it start to firm up and see it start to relatively outperform before I put money to work.
Got it. Okay, let's go get to one more phone call before a break. Chris is on the line from Victoria with a question. Hi, Chris.
Hi, Marella. Hi, David. David, when you come on the show, I always remember when you say we like to buy companies that are good getting better and not necessarily the other way.
Yeah.
I'm hoping to get your opinion on Freeport-McMoRan and copper stocks in general for the next 5-year time horizon. Thank you so much.
Okay, thank you for the question. Great.
So, Chris, I'm going to come at this a couple of ways. First of all, we all know that recently there was a very significant drop in the price of copper in North America and in COMEX, and that was as the tariffs were clarified coming from President Trump. I would note that the copper stocks were remarkably resilient when that happened. So that's a clue.
Good thing.
Right? Now, Freeport is sort of the granddaddy in copper production, copper and gold. They've got, wonderful long life asset. It's trading above, the 50, the 150, the 200-day moving average. Is it the strongest copper stock? Technically, no. We own the stock, though, and technically it's fine. I'm going to talk about another copper stock today that I think is more timely. But look, this is a great company. They've got a great history of raising their dividend over time. I'm focused on cash flow generating assets right now, and companies where if inflation rises tomorrow, they can put their prices up, and copper producers tend to be that case. So we like copper. I would own Freeport here. It's probably not my number one pick, but I'd certainly be happy owning it.
Got it. Okay, we're going to take a quick break. David Murrow is sticking around to answer your questions. We're back in a moment. Welcome back. Thanks for joining us on Market Call. We are going to the phone lines to hear Elliot from Hamilton, Ontario. Elliot, what's your question today?
Good afternoon. I'm interested in this potential merger between Capital One credit card company and the transactions platform, Discover. I think between the two of them, the synergies and the growth potential look excellent. Your assessment, please, of COF. Thank you.
Sure.
Okay. Capital One.
So, Elliot, we really like financials. It's by far our biggest weighting across portfolios. We're close to 25% financials.
Okay.
In Canada, the U.S., and globally. We, in particular, like the banking side of things. We did have a very large allocation to insurance, but more focused on banking now. This is a really interesting transaction. The stock has been behaving exceedingly well, trading better than 85% of companies in the S&P over the last 52 weeks. They've been actively buying back stock. It's a dividend growth story to begin with. And this deal offers them lots of opportunity for synergies. So, look, we're outperforming the sector in Capital One, and we like the sector. So I have no reason not to buy that. I think that's something that's quite interesting.
Got it. Okay, let's go back to the phone lines. Moaz is on the line. He's in Vancouver. Moaz, what do you want to know about today?
Thank you for taking my call. David, you are one of my favorite market call guests. I never miss your show. Thank you. My question is on Rio Tinto. I think you covered part of the question when you talked about FCX. And so I was going to ask you, with its copper exposure and the demand for copper right now, would you consider buying it at this level, or do you have another copper producer that you have in mind that you are going to suggest later on?
Sure.
Thank you.
Okay, sorry, some of that cut out. Did you get the question?
I got the message. So we like materials. I like copper. The only problem with Rio is it's got a very significant iron ore component to the business, and iron ore has been not as strong. So like close to 60% of revenue is iron ore.
Okay.
Asia's getting better. Asia, they sell a lot into Asia. China is strengthening. I think that's a positive. The very long-term chart is very, very attractive. I'd like to see the stock break out. Right now, it's trading below the 200, the 200-week moving average, and the 200-day. If it could trade north of $65, I think that would break the stock out. You can see on that chart you've got on your screen that there's sort of a wedge-shaped price pattern there. It's a great dividend payer. They'll pay a solid dividend and special dividends. So it's a big cash flow generating company. Probably it's just a little bit early. And I will talk about another copper producer later on.
Got it. Okay, Moaz, I hope that helps you make a decision. Jerry's on the line in Vancouver. Hi, Jerry.
I like looking for stocks that have been kicked to the curb a little bit, particularly ones that pay good dividends. My question is on UPS. Do you like it at these levels, and do you think the dividend is sustainable? Thank you.
Right.
Okay, thank you for the question. Where do you stand on this kind of service where you have, delivery, which we expect to be trending upwards, more people are online doing their shopping, that kind of thing, but you have a stock like UPS, which is down as much as it is from the start of the year. Is that a tariff effect, or what's going on?
Well, there's a combination of things. Transport stocks in general have been weak. So you've got the sector you're going against. This has been one of the weakest stocks in the sector. They've got an execution problem. Some of their execution has not been good. I'm the last guy to try and pick a bottom. Okay, so it's a 7% dividend at $6.50. They're hoping to make $6.50 this year. So it's not like you've got huge coverage on that dividend. Now, I don't expect them to cut it, but it doesn't inspire confidence when the entire earnings will go to paying a dividend. So I think that there's better places, and I would stay away from this one.
Got it. Okay, back to the phone line for Ghulam, who is calling today. Hi, Ghulam.
Hi there, good afternoon. My question is on GE. I used to own General Electric shares, and then I received three stocks, the Vernova, the Aerospace, and the Health Sciences. I'm just about my breaking even point. Do you see much further upside on it, or should I get rid of one of those three and put the money into QQQ? I'd like your opinion, just a diversification strategy.
Sure.
Thank you.
Thanks for the question. Go ahead.
So, Ghulam, first of all, buying QQQ is a pretty crowded trade.
Meaning?
Right? Meaning everybody owns these companies, and they're good companies, but everybody owns them. And I would argue there's much better risk reward coming from some other sectors than just going to buy QQQ.
Okay.
Actually, I think this is a time when an active investor picking stocks could really add a lot of value. The multiple on the average stock in the QQQ is not cheap, and there's some wonderful companies in there, but I don't think you're doing anything special with that.
Okay.
We own both GE Aerospace and GE Vernova. They are both dynamite companies, and they're better apart than together. The GE Vernova's just had a nice little pullback, but the long-term chart looks great.
Okay.
Their backlog for turbines is very deep, and they'll be selling them into both the natural gas peaker plants and also into the new nuclear plants that are coming. And you can't buy a turbine and get it in the foreseeable future. So they've got a great order backlog. GE Aerospace, they're doing very well. Partly because their maintenance business has been very strong in jet engines.
Okay.
But they also have a newer generation of jet engines coming, which will do very well also. So I would hold both those stocks. And I can't comment on the healthcare piece because I haven't looked at it closely.
Got it. Okay, we're going to take another quick break. When we come back, we'll take a look at David's past picks, see how they did. We're back in a moment. Welcome back. Time now to go through David's past picks from September 4th, 2024, so just under a year ago. At the time, David chose Imperial Oil, IMO on the TSX, and it was 96.04. It is now up to 115.72, so a 20% upside for return, 23% total return. Oil has been beaten down a lot at the start of the year. It's kind of settling in around 60-ish, I would say. Is something like oil, are you carrying this stock forward, hoping that the price of oil will sort of gradually kick back up again? The surplus is playing into this?
So a very smart friend of mine, who was a very high-profile businessman in Canada, said to me one time, when you buy a natural resource company, you're buying an option. You're buying an option of what they have in the ground. You don't know when a commodity bull market will come, but there will be one, and you need to know they'll be there when it happens. So Imperial Oil is the third lowest cost major producer of oil. They are very, very efficient. They have very long life reserves, 25 years reserves. So if you're looking for an option, they're going to be there, and they have the stuff in the ground.
They're ready for it when
They're
it,
ready
as you
for it when
said.
it comes.
Yes.
They have been paying down debt in their balance sheet. It's virtually to where they want it. And they've said they will return all of the cash flow to the shareholders by way of dividends or share buybacks. So it pays a great dividend. It grows its dividend over 20% a year. The price of oil is depressed. When will it go higher? I don't know. But look, find me another oil company that has performed like this over the last 52 weeks in a tough environment. That's what I want to own. I want to own the leader, the one that has the easiest time hiring the best employees, the one with the lowest cost of capital. And in general, we'd want to own companies that generate cash and are paying it out to us as shareholders, because if I can get a rising stream of income against a rising cost of living, that's pretty darn good. And I think people in general focused on high dividends that aren't growing, and I don't think that's a great way to focus in this world.
You mentioned Imperial Oil is one of three, or at least third in the list, where it performs well, even in lower oil price scenarios. Who are the other two?
Well, you've got Aramco, which is, so it's the only one. It's the only one in Canada that has this low cost base.
Got it. Okay, let's go to your next past pick from September last year. Sprott Physical Gold Trust, recommended at 26.25 on the TSX, up down to 35.56. 35% return, same for total return. Is this a pick you like moving forward?
We've moved from a disinflationary world to a reflating world, and I've talked about this over the last 3-4 years. I think if we're looking for hedges in our portfolios, the hedge isn't against disinflation. So you want bonds if you think there's disinflation. If you think there's inflation, you want an inflation hedge. And I saw an interesting statistic. Only 40% of investors have any gold at all. The average weight is 2% in a portfolio. I can tell you there have been cycles in the past where it's a lot more than that. And I think it's an under-owned asset. It's providing a great hedge. It's not behaving the same as stocks. And I think that we are in probably the first leg of a 10-year bull market. So I would make sure that there was some gold exposure in your portfolio.
Got it. Okay, let's go to your next past pick, JP Morgan in New York, at 219.33 US at the time recommended, up to 290.37 currently. So 32% return, 35% total return. I imagine this is something you're sticking with, have held for a long time.
We've owned it a very long time. It's the leader in the capital markets banks. When somebody gets into difficulty, they get pushed into JP Morgan's hands. They generally do pretty well. We own Canadian banks, we own a couple of US banks, and we own a couple of big global banks that I think are very timely right now. But look, JP Morgan's raised its dividend twice in the last year. They have by far the best technology platform. They got the most solid balance sheet, and price is doing what you would expect it to do given what we think we know. So I'd be a buyer here.
Got it. All right, we are going to take a quick break. Back with more of your phone calls for David Burrows of Barometer Capital Management. We're back in a moment. Welcome back, and thanks for joining us. Mark's on the line. He's in Milton, Ontario, with a question. Hi, Mark.
Hi there, David. Your thoughts on United Health? What do you think of stock going forward, and would you consider initiating a position at these levels? Thanks.
Thank you for the question. So I think you're going to get a lot of United Health questions now that Berkshire Hathaway stepped in to buy a big chunk of it. It's been flailing for most of the year for so many different reasons, and I don't know how long it's going to take for them to resurrect the stock.
Keep in mind that when Warren Buffett starts buying a stock, it's not the last stock he's going to buy. So, look, I am not Warren Buffett. You know, I will never try and say the market's wrong, I'm right. Warren Buffett seems to be quite good at it. It's not my strategy. So we have avoided healthcare for the last 18 months across our portfolios. We have one holding. We have Boston Scientific, which has been bucking the trend. So I'm not in the business of trying to catch a falling knife. And obviously, Warren Buffett's very smart. He gives you a reason to look at it and say, well, if he's there, then I can understand. But based on the way we buy things, I can't buy the stock. Interestingly enough, the decline has been about 62% of its last 5-year gains, which would be a typical sort of collapse of a stock. But the number of sellers that are just waiting for their chance to get their money back at higher prices means that going forward, you're going to have to churn through all those sellers. And very rarely is a stock like this going to bottom on a Tuesday and start heading higher for good on a Friday. You're probably going to have to deal with some bumpiness, some backing and filling. And I just think there's other things that give you better, more timely opportunities.
Got it. Okay, Mark, thank you for the question. Let's go to Pooja from Oakville, Ontario. Hi, Pooja.
Hi, good afternoon, Mirella, David. Thanks for taking my call. David, I would like your insight on CN Rail. I was listening to their earnings call not too long ago. The leadership withdrew their forward guidance. Obviously, there's a lot of exposure with the merger on the horizon with UP. And then one of the big red flags for me was the chief commercial officer either quit or was let go. They didn't talk much about it. I have a significant chunk of investment in CN Rail. It's like a cornerstone stock for a lot of folks in their portfolio. So would really appreciate if you can kind of guide me. Is this a good time to invest more or kind of eventually get out of it?
Okay, thank you for the question. Transportation, you mentioned, has been beat up.
Yeah, so I would say in general, first of all, we're avoiding transportation. It is an obvious place that can get impacted by tariffs. CN Rail, the majority of their traffic is north-south between Canada, the U.S., and Mexico, so that's a question mark. Analyst estimates have been coming down, and they haven't sort of flattened out or started to see improvements. And the stock obviously is on the low, so it's too early for us. Remember, in a bull market, you need 20 to 25 positions to have a diversified portfolio. It's like if you own a store and your inventory isn't selling, you mark it down and get rid of it and replace it with stuff people want today. You only have so much shelf space. Same in your portfolio. So when something isn't working and there's no sign that you can come across that says it's about to change, then probably you move on and do something else because you only have so much capital.
Okay. So it's at 131. I don't know how long he's been in the stock. Is this a position you'd begin to sell off, or would you kind of hang on for?
I would. I mean, I know it's down a lot, and I think it's a good company. So, you know, if you have unlimited time and patience, that's fine. I just think that you have to deploy your investment capital in things that are going to generate a return in the near term, and that's what makes a good retailer, and I think that's what makes a good portfolio manager.
Got it. Okay, let's go back to Kevin in Toronto with his question. Hi, Kevin.
Hi, Mirella, David, thanks for taking my call. David, I own BCE. I have 2 full positions in it, and I don't have a lot of faith in it right now. I'm wondering if I should sell it, put some into TELUS, or if you have any suggestions in your top picks. Thank you.
Okay, thank you for the question, BCE. We have to mention it's the parent company of this channel under the Bell Media brand. A bit of a turnaround from the $30 mark more recently. What do you think of telecoms in general right now?
In general, it's actually quite a mixed bag. There are a couple of telecoms in the U.S. that are behaving pretty well. AT&T is a good example. I would be a seller of the stock. I mean, we've said be a seller. It's trying to make a turn here. Maybe that will be the case, but it's not my first choice to put on a new position. And I think that there's other things you can do.
So other things outside of telecommunications in general.
Yeah.
Okay, got it. Let's go to William from London. He has a question. William, what's your question today?
Good afternoon. Thank you for your past suggestions. What is your opinion on BNT? I've had it for a long time, and I think it's splitting shortly.
Okay, thank you for the question. Brookfield?
Yeah, so this is the Brookfield Asset Management Reinsurance. It's behaving really, really well. Okay. The insurance sector has been behaving well over the last 3 years. We have a big Fairfax position, which we trimmed about a month ago. Okay. So it's still a good-sized position. I prefer the capital markets banks currently in the financials, but I have nothing that I can point to that's a problem there.
Got it. Okay, we are going to take a quick break. We'll be back with David in just a moment. Stay tuned. Welcome back. We are going straight to the phone lines. Mark's holding on the line. He's in Cochrane. Hi, Mark.
Hey, Morel and Dave. How are you today?
We're good. How are you?
Good. My question is on Whitecap Resources. It's one of the few energy stocks that pays a monthly div, roughly 7+%. Is the div sustainable, and do you own it?
Okay, good question. Thank you.
Okay. Mark, on Whitecap, we own really only a couple of energy companies, and they're quite different. We own Cheniere for its energy infrastructure and liquefied natural gas, LNG, and we own Imperial. Whitecap, the stock has behaved pretty well given what's going on out there. We don't own the stock. It's trading above all the moving averages. It's one that I probably would have on the list. The dividend looks like it's safe at this point. But again, I'd be looking for a catalyst. I'd be looking for a catalyst in the energy sector before we added anything new.
Got it. Okay, let's go to John from London, Ontario. Hi, John. What's your question today?
Hi, Merle. Hello, David. Thanks for your comments on GE. I doubled down on GE, and I got the three components, and the sum of the parts was greater than the whole. Is Honeywell going to pull the same trick? They're splitting into 2 or 3 components. Do you see that as a good long-term hold and maybe an add here? I think industrials are one of your favorites at this time. Thank you.
I think Honeywell is really interesting here, and I would be watching it. The long-term chart, I think, is favorable. It's trading around the 50-day moving average technically. Moving averages are moving higher. If they could create a split, I think that would be very favorable. When companies do these spin-offs, they set the spin-offs up for success. And interestingly, like the call earlier, you'll often have an investor winds up with 3 pieces. They don't really understand them individually, and so they say, well, I'm going to sell that and move on. And so very often when these spin-outs take place, after the first little while of trading, institutions are probably in there buying the piece they want, and individual investors are selling because they don't understand what it's worth. You can unearth a lot of value when you take a company like this apart. So we like industrial process and industrial automation. Honeywell is a very diverse company, but they have a lot of interesting components. So I would be comfortable owning that stock.
Got it. Okay, thank you for the question, John. We are moving on to another John, I believe, from Winnipeg, with a question about grocers. John, what's your question today?
Between Loblaws, hi, thanks for taking my question. Between Loblaws, Empire, and Metro, which is your favorite going forward?
Okay, thank you for the question. Loblaw just did a split, didn't it?
Yeah, so just let's talk about that for a second. I better say Loblaws because that's the one we own.
Okay.
We're a long-term holder of Loblaws. We think that they're very good operators, but we think that the shopper's business is probably the best part of the business.
It's the biggest part of the business as far as numbers of locations.
Yeah, I mean, it's just they changed the model for pharmacy, and they have done a really great job of merchandising and a really great job of executing. The stock's trading at a new all-time high, basically today. But so it's not cheap. But again, you're buying the best. So I think Loblaws is the one I'd want to own.
Got it. Okay, that was easy. Let's go to Anne from Toronto, Ontario. Hi, Anne.
Hi, David. Why have shares in Cameco been steadily dropping? Today it dropped $5. And should I buy more at this price? Thank you.
Okay, thank you for the question. So a lot of people are excited about Cameco, uranium, nuclear pushing up.
Yep.
What's been leading to this drop, if anything obvious?
I said early in the show that in the last few days there's been sellers in momentum stocks, things that are maybe a little more crowded. And I think Cameco and the nuclear stocks have been caught up in that.
Okay.
I think that the long-term picture for nuclear power is really strong. And Cameco is the first of all of the uranium producers to have broken out technically. And now I'm talking about that was a while ago, but it broke out to new highs in 2022.
Okay.
And making first new high since 2007, 2006. And I think it's the beginning of a long-term bull market. So the stock's pulled back a little bit. I'd be a buyer.
Are you
technically it's sound. We own Cameco. I have exposure to nuclear. It's one of the same reasons we own GE Vernova. We think that the demand for power is going to continue to grow, and this is one of the links in that chain.
Okay. Let's get to an email before we have to wrap up phone calls and emails. This is from Bill. He says, hi, David. Can I get your opinion on Couche-Tard? What did you think of Couche-Tard moving away from its effort to pick up some 7-Elevens from the Japanese parent company, which it seemed to have a hard time trying to get those owners to move forward on anything? Right. What did you think of them, Couche-Tard, then pulling back?
Okay, so we don't own the stock currently. And we did own the stock for a long time, but our sense was that the growth was waning a little bit and they needed to do a deal to give them their next opportunity. And so I think I was on the day after they announced that target. And I said, if they can, if it looks like this is going to get done, we would probably re-enter the stock. And of course, they haven't been able to get it done. If you take the lens back and look at the weekly chart, it's trading, a little above the 200-week moving average. The stock had a tremendous run from 2021 to 2024. So the fact that it's had, 18 months of sort of chop or 16 months of chop, I think is natural. So I think that they're good operators. They're good from an execution perspective. Never say never with this 7-Eleven thing. I mean, these things have a way of coming back around. But I think that this is probably not a terrible entry point for the stock.
Some suggested they get their growth from mergers, and they went for a very big one that didn't happen. Is there other opportunity for them, either in North America or
There isn't another one like 7-Eleven. There isn't another one like 7-Eleven. But, they're very good at making these acquisitions and tidying up the stores and putting money into it and improving their systems. And I wouldn't want to bet against them.
Got it. Okay, we're going to take a quick break. We'll be back with David's new top picks in a moment. Stay tuned for that. Time now for new top picks from David Burrows. He has MDA Space at the top of the list on the TSX. They have doing very well with their low orbit satellites. They've been signing a lot of contracts there. Is that primarily why you like the stock moving forward?
Yeah, so look, we take care of money for families. And we think that if they want to go and buy the whole market, go buy an ETF. But why do you want to lug the bad companies with the good ones in an index? I think we can target big secular long-term themes where companies get revalued over a period of years. So one of the themes we've been focused on is space. The space economy is very early stage, and it's going to go on for a long time, right? I think that that's clear. So MDA Space is fully exposed to the space economy. They have 3 basic vertical markets that they sell into. They do robotics and space operations. They do low orbiting satellite systems, and they do geointelligence, sort of the defense type stuff. The thing that they're known best for right now is the low orbiting satellites that they've been selling into building these large networks to provide Wi-Fi through satellite. And it's a huge, huge market. They've got a $6.4 billion backlog in that area. It's growing. The space economy, is going to be $1 trillion opportunity. So they are a leader in the group, and we think that it's a great way to participate. They've got a clean balance sheet. They have made interesting strategic acquisition of Satixfy, which is a manufacturer of satellite chip systems. So there'll be lots of opportunities for cost synergies and revenue opportunities. So this is technology, it's space, and it's a growth stock.
Got it. Okay, let's get to your next topic, Hudbay, which is copper and gold. And this is the copper stock you had mentioned during the show that you like. Tell me why Hudbay is the one you would pick in that space.
Right. So we like copper long-term for the power opportunity, and because for a decade, nobody invested in new capacity. We talked about why we like gold. Hudbay has both. So when we own a mining company, we want to own a multi-mine, multi-jurisdictional company, right? Where you're not all your eggs in one basket, where something can change and really cause a problem, as First Quantum found out. So they are an operator in copper and gold production. They produce cash flow, so it's a solid operating business. But what's most interesting is they have a very large opportunity to build a development called Copper World, which is in Arizona. Okay. We've all heard Trump say, we want our own copper production. So they're in the sweet spot. Mitsubishi, who, for people that don't know, are very well known for financing very large copper projects, like Antamina, for instance. Just recently committed $600 million to build out Copper World. That means they're funded. They don't have to sell any more equity. The deal was done at a price that was much higher than the street expected, so like 1.6, 1.7 times net asset value, which means it will be a very accretive deal. And the stock technically just broke out of like a 5-year base. Okay. So technically, I think it's really attractive. It's a mid-cap stock that ultimately could become somebody's target. We know that these companies get eaten up at some point. So I think it's timely and well-financed.
Okay. Let's get to your third pick, which is a Vanguard FTSE ETF. And you specifically want to put some money outside of North America?
We're encouraging. We've taken our clients up to a 15% weight in global equities outside of North America. The problem is most global funds are like 60, 70% U.S. stocks, which we don't need to replicate. We have a global fund that owns 80 global companies. Vanguard ETF is a way to do that. They have an ETF that ultimately represents the ex-U.S. index. But look, valuations are much lower in global stocks. When a cohort breaks out to new highs after many years of underperformance, like global stocks had 10 years of underperformance, it generally tends to be the beginning of a longer-term bull market, and we're like 1 year into it. So I think everybody needs to have some global equity exposure, and the sectors that make up the global equity universe are largely like financials and industrials and materials, which are the sectors that are leading. So this is a way to do that.
And when you talk or look at the global scene, are there specific markets that you prefer, sort of Europe over some of the emerging markets? Where do you look?
Interestingly, like if you look at financials around the world, financials are outperforming North American financials in global markets. So European financials look great and European industrials look great. The Asian markets, both Japan and China, are interesting for different reasons. Both are performing well for the first time in many years. There's lots of mid-sized companies that you wouldn't know the name of that are priced really attractively. And so the way to do that is probably through a fund. We have single stock picks that we've made, like Santander here on the show and Embriar. But just having some exposure in the portfolio, I think, is really, really important.
Got it. All right, Dave Burrows, good to see you. Thanks for coming in.
Thanks for having me.
That's it for Market Call today. Thank you for joining us. We'll see you again tomorrow.